Hey everyone, welcome back to Finance Kita, your go-to place for all things finance knowledge. Today we're diving into a topic that's super relevant for those of you looking to ace your interviews in the finance world, specifically for chartered accountants. We'll be focusing on some key interview questions related to hedge fund accounting. So, if you're gearing up for an interview, grab a cup of coffee, settle in, and let's get started. First up, let's tackle the question: what is the role of a fund accountant in a hedge fund? When answering this, you want to highlight that a fund accountant is primarily responsible for maintaining the financial records of the hedge fund. They ensure that all transactions are accurately recorded, which includes everything from trades to withdrawals. They also calculate the net asset value, NAV, of the fund, which is crucial for reporting to investors. Fund accountants play a vital role in preparing financial statements and ensuring compliance with regulations. They often work closely with portfolio managers and other finance professionals to provide insights on the fund's performance. So, remember to emphasize the collaborative nature of this role and its importance in the overall functioning of a hedge fund. Now, moving on to the next question. What is NAV, net asset value, and how is it calculated for a hedge fund? In your response, you should explain that NAV represents the total value of a fund's assets minus its liabilities. It's a critical measure because it provides investors with a snapshot of the fund's worth at any given time. To calculate NAV, you would take the total market value of all the fund's investments, subtract any liabilities, and then divide that by the number of outstanding shares. It's important to mention that NAV is usually calculated at the end of each trading day and is essential for determining the price at which investors buy or redeem shares in the fund. Next, we have: how do you handle accruals and prepayments in hedge fund accounting? When addressing this question, clarify that accruals and prepayments are key components of the accrual basis of accounting, which hedge funds typically use. Accruals involve recognizing revenues and expenses when they are earned or incurred, regardless of when cash is actually received or paid. For example, if a fund earns interest income but hasn't received the cash yet, that income would still be recorded as an accrual. On the other hand, prepayments are expenses paid in advance, like insurance premiums. You'd want to explain that these prepayments are recorded as assets on the balance sheet and then expensed over time as they are incurred. This distinction is crucial for maintaining accurate financial records. Now, let's talk about: what is the difference between realized and unrealized gains/losses in a hedge fund? In your answer, you should highlight that realized gains or losses occur when an asset is sold for more or less than its purchase price. For instance, if a hedge fund sells a stock for a profit, that profit is considered a realized gain. On the flip side, unrealized gains or losses refer to changes in the value of investments that have not yet been sold. For example, if the value of a stock goes up, but the hedge fund hasn't sold it yet, that increase is an unrealized gain. It's important to stress that while realized gains affect the fund's cash flow, unrealized gains and losses impact the fund's overall valuation. Next question. Can you explain the accounting treatment for derivatives, e.g., futures, options, swaps, in a hedge fund? When discussing this, make sure to mention that derivatives are complex financial instruments used for hedging or speculation. The accounting for derivatives can vary based on the type and purpose of the derivative. Generally, derivatives are recorded on the balance sheet at fair value. If the derivative is held for trading purposes, changes in fair value are recognized in the income statement. For hedging derivatives, the accounting can be a bit more complex, as it involves assessing whether the hedge is effective and then applying hedge accounting rules. This is a great opportunity to highlight the importance of understanding the purpose of each derivative and the associated risks. Now, let's move on to: how do you account for dividends and interest income in hedge funds? In your response, clarify that dividends and interest income are typically recognized on an accrual basis. This means that you record the income when it is earned, not necessarily when it is received. For dividends, you would recognize the income on the ex-dividend date, which is when the dividend is declared. For interest income, you would accrue it based on the effective interest rate method over the life of the investment. It's also important to mention that both types of income would be reflected in the income statement and impact the fund's overall profitability. Next up is: what is the process of allocating profits and losses to investors in a hedge fund? When discussing this, Explain that profit and loss allocation in hedge funds is typically based on the terms outlined in the fund's limited partnership agreement. Generally, profits and losses are allocated to investors based on their proportional ownership in the fund. However, certain funds may have performance fees or hurdle rates that affect this allocation. It's essential to mention that this process can be quite complex, especially if the fund has multiple classes of shares or different fee structures. So, being clear about the specific terms of the fund is crucial when explaining this process. Now, let's tackle: how do management and performance fees work, and how are they accounted for? In your answer, you should explain that management fees are typically calculated as a percentage of the fund's assets under management, EUM, and are charged regardless of the fund's performance. Performance fees, on the other hand, are based on the fund's returns and are only charged if the fund exceeds a certain benchmark or hurdle rate. In terms of accounting, management fees are usually recognized as an expense in the income statement, while performance fees may be accrued at the end of the reporting period, pending the fund's performance. It's a good idea to emphasize the importance of transparency in these fees, as they can significantly impact investor returns. Next question: what are the key differences between hedge funds and mutual funds from an accounting perspective? Here, you should highlight that while both hedge funds and mutual funds are investment vehicles, they differ significantly in their accounting practices. Hedge funds often engage in more complex investment strategies, including the use of derivatives and leverage, which require more intricate accounting. Additionally, hedge funds typically have fewer regulatory requirements compared to mutual funds, which must adhere to stringent reporting standards. You can also mention that hedge funds usually have higher fees and less liquidity than mutual funds, which can affect how profits and losses are reported and allocated. Now, let's discuss: how do you account for foreign exchange, FX, transactions in a hedge fund? In your response, explain that FX transactions must be recorded at the exchange rate on the transaction date. Any gains or losses arising from fluctuations in exchange rates should be recognized in the income statement. For reporting purposes, hedge funds may need to convert their financial statements into a reporting currency, which can involve additional adjustments. It's important to highlight that managing FX risk is crucial for hedge funds, especially those with international investments, as it can significantly impact overall returns. Next, let's move on to: can you explain the importance of fair value accounting in hedge funds? Fair value accounting is essential in hedge funds because it provides a more accurate representation of the fund's current financial position. Since hedge funds often invest in illiquid securities or derivatives, fair value measurements help ensure that the reported values reflect the market conditions accurately. This approach enhances transparency and allows investors to assess the fund's performance more effectively. You should also mention that while fair value accounting can introduce volatility in financial statements, it ultimately provides a clearer picture of the fund's worth. Now, let's tackle: how do you account for private equity investments or illiquid securities in a hedge fund? When answering this question, explain that private equity investments and illiquid securities are typically valued using a combination of methods, such as discounted cash flow analysis or comparable company analysis. Since these investments may not have a readily available market price, it's crucial to apply a consistent valuation methodology. The valuation process often requires significant judgment and should be documented thoroughly to ensure compliance with accounting standards. It's also important to highlight that the valuation of these investments can impact the fund's NAV and, consequently, the returns reported to investors. Next up is: what is the importance of maintaining accurate books and records for a hedge fund? In your response, emphasize that accurate books and records are vital for several reasons. First, they ensure compliance with regulatory requirements, as hedge funds are subject to audits and reporting obligations. Second, accurate records help in the timely preparation of financial statements and investor reports, which are crucial for transparency and trust. Finally, maintaining proper records allows fund managers to make informed decisions based on reliable data. It's essential to stress that a strong accounting framework is fundamental to the success of any hedge fund. Now, let's discuss: how do you perform month-end and year-end closing for a hedge fund? When answering this question, explain that the month-end and year-end closing processes involve several key steps. First, you would need to ensure that all transactions for the period have been recorded. Next, you would perform reconciliations of cash, positions, and trades to ensure accuracy. After that, you would prepare the financial statements, including the balance sheet, income statement, and statement of cash flows. Finally, you would review the results with management and prepare any necessary reports for investors. It's important to highlight that these processes require attention to detail and a thorough understanding of the fund's operations. Next, can you explain the process of preparing investor reports in a hedge fund? In your response, clarify that investor reports are typically prepared on a quarterly basis and include key information such as the fund's performance, NAV, and a breakdown of fees. The process begins with gathering data from the fund's accounting system, including performance metrics and financial statements. Next, you would analyze the data to provide insights into the fund's performance relative to benchmarks. Finally, the report is compiled, reviewed for accuracy, and then distributed to investors. It's crucial to ensure that these reports are clear, transparent, and provide value to the investors.